Want to know how to maximize your tax deductions for 2024? Well, you're in the right place. Understanding tax deductions is crucial, as these can greatly impact your overall tax bill. By strategically planning and utilizing these deductions, you can significantly reduce the amount you owe to the taxman. In this video, we'll help you navigate the complex world of tax deductions. We'll cover a range of strategies, from itemizing deductions, understanding tax credits, using tax-advantaged accounts, to timing your expenses right. Itemizing deductions, for instance, can be a game changer if your eligible expenses surpass the standard deduction. Leveraging tax credits, on the other hand, can directly cut down your tax bill, and that's just the tip of the iceberg. Ready to dive deeper? Let's explore each strategy one by one. Stay with us as we guide you on how to keep more of your hard-earned money in your pocket in 2024. First, we tackle itemizing deductions. Wondering what that means? Well, when you file your taxes, you have two choices. You can take a standard deduction, which is a fixed amount that reduces your taxable income, or you can itemize your deductions. Itemizing means tallying up all the expenses you've made throughout the year that the tax code allows you to deduct. Common deductions include mortgage interest, charitable donations, and medical expenses, exceeding a certain percentage of your income. For instance, if you've paid a lot in mortgage interest or made sizable charitable donations, itemizing could be a good move. But remember, it's crucial to keep accurate records of these expenses. However, itemizing isn't for everyone. It requires time, organization, and sometimes the total amount might not exceed the standard deduction. So, it's essential to calculate whether itemizing or taking the standard deduction will save you more. Remember, being tax savvy is all about making informed decisions. Next on our list are tax credits and tax-advantaged accounts. Sound complicated? It's simpler than you think. At their core, tax credits are a dollar-for-dollar reduction of your tax liability, while tax deductions reduce how much of your income is subject to taxes. In other words, tax credits are like coupons that directly slash your tax bill, whereas tax deductions lower your taxable income. There's a plethora of tax credits out there, but let's touch on a few popular ones. The child tax credit, for instance, directly reduces your tax bill if you have eligible children. The American Opportunity Credit, on the other hand, can provide significant relief for those paying for education. Now, let's switch gears and talk about tax-advantaged accounts. These accounts, including 401ks, individual retirement accounts or IRAs, and health savings accounts or HSAs, offer opportunities to save money for specific purposes with tax benefits. A 401k or IRA, for example, allows you to stash away money for retirement and either deduct these contributions now or withdraw the funds tax-free later. Health savings accounts, on the other hand, provide a triple tax advantage. Your contributions are tax-deductible, the funds grow tax-free, and withdrawals for qualified medical expenses are also tax-free. Take advantage of these credits and accounts. They can significantly reduce your tax bill if used correctly. Finally, let's talk about the timing of expenses. Timing, as they say, is everything. You see, when it comes to tax planning, the calendar plays a crucial role. A slight shift in when you make certain payments can significantly impact your tax deductions or credits. For instance, let's consider mortgage interest. If you're a homeowner, you're likely making monthly mortgage payments. But did you know that by prepaying some of this interest before the year ends, you could increase your tax deductions? Yes, that's right. By simply shifting the timing of this expense, you can make your money work smarter for you. Similarly, making a last-minute charitable donation can also boost your deductions. So if you're planning to support your favorite charity, consider doing so by the end of the tax year. That way, not only are you contributing to a good cause, but you're also potentially reducing your tax bill. Now remember, these are just examples. The key takeaway here is that strategic timing of expenses can play a significant role in your tax planning. It's not just about how much you spend, but also when you spend it. Strategic timing can make a huge difference. Keep this in mind as you plan your expenses throughout the year. So what have we learned today? Key strategies to maximize your tax deductions for 2024 include itemizing deductions, making the most of tax credits and tax-advantaged accounts and timing expenses effectively. It's also crucial to remember that each individual tax situation is unique. Therefore, consulting with a tax professional can provide personalized guidance to optimize your deductions. Remember, a little planning can go a long way in reducing your tax bill. Here's to a tax-efficient 2024.